people losing their homes. So for me, after I saw that, I realized I had to do something different and I had to get on it quick.
If you're investing, investors will.
The podcast for all things real estate investing.
Welcome back to another episode of Investor One on One. Today's guest made his name long before real estate as a professional snowboarder for over 13 years, taking home multiple X Games gold medals and earning global recognition as one of the top urban snowboarders in the world. Now he's a co-founder and managing partner of Granite Towers Equity Group, a multifamily investment firm helping hundreds of passive investors build long-term wealth. Based in Southern Washington, he leads operations, acquisitions, investor relations, and asset management. And he's also the co-host of Keeping a Real Estate podcast and co-author of Four Steps to Successful Passive Investing, a blueprint for building wealth through syndications. From a world-class athlete to a real estate leader, his story is all about discipline, mindset, and creating freedom through smart investing. So let's get into it, and please welcome to the show, Dan.
Thank you. Glad to be here.
Pleasure having you, Dan. So, yeah, man, you have an amazing story, and we're looking forward to hearing more about it today. As I said, you're at the top of the snowboarding world, X Games, gold medals, global recognition. What made you shift gears and dive into real estate?
I got to a point in my career where I could see it was going to end, and it got scary. I could see all of the guys who I got to know very well, their careers were winding down, and I saw the life of a professional athlete after snowboarding, and it was brutal, like suicide, actually. Like their identity shifts. Like you're not, who are you after you're an athlete? You get this idea that you're nobody anymore, and it's not how it is, obviously, but if you've been obsessed with something for 15 or 20 years and your identity is that you're a professional athlete and then it ends, it can be a massive jolt. I saw drug addiction. I saw people losing their homes. So for me, after I saw that, I realized I had to do something different and I had to get on it quick because I didn't want to be back at TGI Fridays busting tables. I grew up a very um, minimal, I guess, childhood. I didn't have a lot. My parents gave me love and support, but they didn't have extra money. So for me, it was work really hard at a night job, snowboard every day, eat peanut butter and jelly for breakfast, lunch, and dinner. And when things took off, it was a gift. And I realized it was going to be short-lived, and I wanted to take the time and invest the capital I was making in and put it into assets to create passive income to create depreciation and to take advantage of inflation. And those are the three things that I learned early on that changed my life.
And as an athlete, what parallels have you found between professional athletics and real estate investing, specifically in mindset and discipline?
Yeah, at the end of the day, it's not much different. It's just a difference of outcome. So as a athlete, the outcome is multiple X Games gold medals. And, as so, it's basically the only difference is the outcome. As an athlete, you're looking for multiple X Games gold medals. As a real estate investor, you're creating passive income for you and for your investors. Everything else is obviously very different action items, but just a very clear outcome and not quitting. I'd say that's the thing I saw the most on the way up in my snowboarding career is I moved out from Minnesota with a group of guys, and those group of guys were all better than me at snowboarding, but every one of them got distracted or quit. Some of them got into drugs, unfortunately. Others couldn't land a trick at a specific spot and realized they didn't have it or thought they didn't have it, so they quit. And so I think the same thing with real estate. What are your 10-year goals and how committed are you to them? I have a great leadership coach, and that leadership coach told me, he said, leadership, commitment moves the world. And I think that's so true. When I look back at my life, I think the biggest reason that things went well in my snowboarding career and are going well in real estate is just commitment, doing what's necessary.
Thanks for sharing that. And let's go back to your first deal. How did that experience shape your investing philosophy? And can you tell us more about it?
Yeah, so first deal, it was the same reason for buying that we're buying today. And that was back in 2012. It was a 9-unit deal. I bought it for passive income. I bought it to hedge against inflation, and I bought it for depreciation. And it worked on all three accounts. Passive income is the most powerful income from my perspective, anyone can earn. And I never heard about it until I was about 28, 29. And that's when everything shifted in my life. I realized like the money I'm making as an athlete is great. But as soon as I get hurt, as soon as I quit, as soon as the brand decides that I'm not valuable anymore, it's gone. And it's pretty fragile, right? There's a lot of other kids coming up that are competing for my spot. And either you're top or you're done. And it's cutthroat in sports. They don't mince words. When I got fired, which I did, it was a quick phone call. Hey Dan, thanks for being on the team for the last 10 years. You've been invaluable, but we're done. And within 3 to 5 minutes, this relationship that I had for 10 years was over. And so again, I saw that coming because some of my senior peers, friends, had that happen to them when I was in my prime. So when it happened, I was a little more prepared. But really, yeah, first deal, it was looking for passive income. I think I put down 130 to 140,000. I ended up creating about 12 to 15% of cash on cash return, which was passive income. Buying it 2012 was really difficult to screw it up because of the timing of the market. So there was a very easy way to create capital gains or hedge against inflation. And then the depreciation went to me. We did a cost segregation study, which accelerates depreciation and gives me a big loss on paper on a K1 and helped me offset some of my income as a snowboarder because my wife qualified as a real estate professional. So that was the first deal.
That's amazing, man. And I love seeing the journey and how you guys are growing. And we spoke in the beginning about how most of the investors that are watching this are single family, and a lot of people, these investors, they do want to go into multifamily. Why did you choose multifamily over single family? I know that people watching this right now, some of them will be like, yeah, I would love to go into it, but a lot are worried about the market. A lot of people are building and there's a lot of supply. So what's your thoughts about that?
Yeah, the reason we went into multifamily, or I went into multifamily, was just the scalability. If you could buy 100 doors and you have 10 units that are vacant, you're still 90% occupied. Whereas a single family home, if you got 1 unit or 2 units and you have one person that leaves, you're 100% vacant. Or if you have a duplex, you're 50% vacant. And I think there's much more buffer because you're buying bigger deals for CapEx expenses. Like I hear a lot of folks that'll buy a single family home and it cash flows 3, 4, $500 a month, and then they have their water heater go out and it's a $4 or $5,000 expense, and that wiped out their cash flow for 4 or 5 years. And so with multifamily, you have the ability to do single family on a much larger scale, and there's more room for error. That's what I've found. And so, and there's ability to raise capital with a lot of investors. It qualifies for non-recourse debt, which Fannie Mae and Freddie Mac is pretty amazing for. You have the ability to drive NOI. I like the control of the value of the deal. Yeah, we don't 100% control the value because cap rates move, and cap rates divided by NOI is your value. So cap rates may shift, but one thing that we have a lot of control over is if you can buy in a submarket where there's extreme pent-up demand, which just means occupancy is 93 to 95% or higher, you're in a place or in an asset that is very likely to have pressure on rents. And so if you can have that scenario, and let's just say you're buying a B or a C class property, there's a lot that goes into that. But if you're buying a B or a C class property and there's a ton of new product coming online, call it A class, it may not affect you as much. It may still, but it may not affect you as much as a brand new A class with a new A class in a lease up position. So you're a little bit more insulated from the new builds. And you can track new builds very easily. How many new starts are in the ground, when they'll be available, what that will likely do to the population growth with the job growth. So for folks that say, there's too much supply coming, or really what I'm hearing is lack of understanding of how to buy an asset in the right location with the right value add strategy, and then how to drive NOI, which takes
So
time.
I agree. And that kind of follows up to my next question. When you guys are investing, I know you guys invest in Texas, Tennessee, and Minnesota, right?
Yep.
So when you guys are investing, what are the key metrics you look for when analyzing or assessing a new multifamily deal? And like what kind of neighborhood are you looking for? What kind of class of property, A, B, or C? And do you guys
Yeah.
invest in cash flow appreciation or both?
Yeah. Yeah, great question. I mean, started off first, we're invested for cash flow first with the a clear value add strategy. So we're looking for assets that are 150 to 350 units. We're looking for newer assets now, something 1985 or newer. And that doesn't mean you can't do well with C-class deals. You know, a lot of our deals are Hispanic population, 1960s, 70 built product. And as long as you underwrite your CapEx, which is the or deferred maintenance, which is the money that's needed in order to maintain the property, if you have that underwritten correctly on the front end and you know what's coming, it's no big deal. It's when you don't know and you didn't underwrite correctly and you didn't get your capex bucket allocated correctly or your deferred maintenance correctly, and now you're pulling on a cash flow and you're cash poor. And if you can build that into your underwriting up front and the numbers work, all good, all day. So uh, we spent the first part of our time with more in that C class product, and we've just recently transitioned to a little bit newer product. We're buying a 2000. We just bought a 2003 product in an A location up in Chaska, Minnesota. We're buying another one in Minnetonka, Minnesota. Our main focus, though, is still Dallas and Nashville. We just saw these two that came up in premier locations 10, 15 minutes from where my partner Mike lives. And the numbers worked. And so, with those premier locations in Minnesota, all good. Minnesota is not our main focus, though. It's more of a we'll keep an eye on the market. And if, premier deals come available, then we'll go after them. But our main focus is Dallas and Nashville. We're again looking for 1985 or newer, 150 to 350 units in the submarkets where we have extreme demand. That's supply and demand controls everything. And so if you can get into a submarket where we're 93, 95% occupied plus, we have a clear understanding of what the deal needs, and we can put 70 to 75% leverage on the deal through Fannie Mae and Freddie Mac for 7 years fixed or more. We feel like it's a pretty safe play, and especially where we are in the market cycle right now. If you're looking back at 21 and 22, a lot of those deals are in pain. And those deals that are in pain, we've had a huge market shift. Interest rates went up, cap rates followed, values came down, and expenses were ripping during the inflationary period. And now we're in a period of time where you've got a lot of deals that were over leveraged, are in a position where they have to sell because of a bridge loan. Or you've got general partners who are bickering and can't get their stuff figured out. They're asset managed poorly. And so you've got product coming available at, 20 to 30, even 35, 40% discounts. So if you know what you're doing and you've got capital ready, a lot of folks we're seeing right now coming back into the market that are investors or family office, bigger money, and potentially wealthier folks that see a window open and they're back and ready to buy.
Whenever you find a deal, let's say, and it comes to raising more capital, what's been your most effective strategy to raise capital from new investors, especially those who are brand new to syndications and hesitant about writing $50,000 or more to a deal?
Yeah, biggest thing is just having a great deal. At the end of the day, you're not really selling anyone on anything. You're just showing them an opportunity of what you're buying and why you're buying it, why you're putting your money in the deal. And so if it's truly an opportunity and you look at all of the different variables to underwrite it correctly and it checks out, um, I would hope that if I'm putting my capital in the deal, that our investors would see that there's potential and upside. That's our job is to analyze and scour the market to bring the best opportunities we possibly can and to put those opportunities in front of our investors. And then after we close, to execute the CapEx efficiently and to asset manage the deal in a professional manner with our third party management company. That's really the name of the game. And then rinse and repeat over and over and over again.
Let's talk a little bit about asset management. It's sometimes some investors don't really like that word. What are the keys to managing properties well after the acquisition phase?
Yeah, you better love the word asset management if you're going to own multifamily apartments. That just so we don't leave any investors behind, you've got your on-site property management company that may be owned vertically integrated or third party. And then you have the lead asset managers, which is generally like a syndication firm like ours, where somebody uh, on the team has helped create a business plan, CapEx plan that will be executed in the first 12 to 24 months to create value. Uh, and it may not always be that streamlined. There may be audibles that are called as the market's telling us, giving us information. I mean, at the end of the day, we're in a market. We create a CapEx plan or business plan the best we can with the data we have today. And if the market shifts, it doesn't mean you just mindlessly put the money into the deal. You're gaining feedback. But the asset manager's role is really leadership, being a great leader, creating a vision and clarity of where we're going with the property management company, bringing in the right vendors, working with the property management company's vendors, verifying the work's getting done on time according to budget, and that the rent is hitting our projections year after year. It is the most intensive, time-intensive job that we have at our firm at Granite Towers, and one of the most critical. I mean, at the end of the day, first and foremost, you have to underwrite and buy correctly. I don't care how great of an asset manager you are. If you don't underwrite correctly and buy correctly and have the right CapEx in the right market, you're going to look like a fool. So step one is you have got to buy correctly. Step two is the business plan has to be executed according to plan and according to what the market is sharing with us. And if you get all that right, you come out with this beautiful asset that's in a cash flow position, where you've driven net operating income ideally drastically, and your CapEx is taken care of, and you've got an asset that can withstand a good 5, 7 year hold period before you either sell or refinance to do another sort of upgrade to the asset.
For sure. And Dan, you've been in this industry for a while and you really know what you're doing and you co-wrote Four Steps to Successful Passive Investing. In your opinion, what's the biggest mistake new passive investors are making and how can they avoid it?
I think the biggest mistake passive investors are making right now is not investing. Um, if you're looking today at deals in the rearview mirror, thinking about 21 and 22, you're missing. Like we're in 2025, we're in a totally different time. Uh, there's a lot of folks who have been doing this for a lot longer than us, and we're getting to know very, very well. And they're all excited about what they're seeing with this window of buying opportunity. One thing I can say that I've learned that's the most impactful thing to be aware of, in since 2012 to now is, yes, buying right is huge. Yes, your debt is huge. Yes, your CapEx is huge. But the most important thing is the window of buying timing. When are you buying in the cycle? And the cycle is not talked about very much. It's not something that's studied. And based off of, the last 250 years here in the US, there is a very clear rhythm of real estate. It's an 18 and three-quarter year rhythm, and it was topped out in 22, 20, 21, 22. And the reset is here, and here we are in 25. Are we at the bottom? I don't know, but we are way off of the top, that's for sure. So I like to think we're definitely somewhere in the smile. I wouldn't be surprised with the depreciation bill just being passed that we are on the cycle's reset. 100% bonus depreciation is back. It's retroactive to January of 2025. And it just allows folks to, going back to, again, remember my three reasons of buying: passive income, hedging against inflation, and depreciation. The depreciation piece is huge and it's back with full force. So you're allowed to take 100% bonus depreciation or cost segregation instead of year one, which gives you massive losses on paper, which allows you to defer your tax bill for a later time, which is incredibly powerful.
And Dan, for whoever's listening to this right now with 50 to $100,000 on the side and wants to start passively investing in multifamily, what's the first step you recommend they take?
First step is get to know a deal sponsor with a track record. And I would strongly consider and ask for, not only success stories, but some failures or some challenges. To be in the business for 3, 5, 7 years and to never have gone through any challenges, I would raise my eyebrows a touch. Whereas if someone's been through some challenges and they've had, yeah, some successes, of course, if you've been around since 2018, 19, you've had successes guaranteed because the market was going crazy through 21 and 22. But for the folks that have gone through 22 to 25 right now, and you've been through some pain and you're here and you've learned some lessons, those are the types of deal sponsors that I'd be excited to invest my capital with because the reality is the more pain you go through, the more lessons you've learned. And the lessons in real estate are brutal. They are slow and they just creep and they just scratch at you and they you learn them deep. And those principles applied correctly, moving forward for this next cycle will be the separator.
I couldn't agree more. And following up to the last question, what's the long term or the next step for Granite Towers? And what's next for you on a personal level?
Next step for Granite Towers is continuing to put the right people in the right seats. We read a great book, our company called Good to Great by Jim Collins. We just implemented EOS, which is an entrepreneur organization system that basically laser focuses the entire team on our 10-year, 3-year, and 1-year targets. And it's just showing up and executing on our major company goals. Every 90 days, we set company goals and we sprint towards those 90-day goals. Boom, you get those done and you set another 90-day goals. It's staying consistent, showing up and staying committed, doing what's necessary. Personal goal for me is more spiritual growth, just meditation, going deeper and working on the sixth sense, I would say, with business of not being such a great listener here, but a better listener right here. And that's my focus over the next few years.
I love that, man. Dan, thank you so much for sharing your amazing journey with us today. It was filled with valuable insights and wisdom. For anyone inspired by your story or interested in learning more about you and Granite Equity, where's the best place to connect with you?
Yeah, www.granitetowersequitygroup.com. And then on that, there's a contact us form. It's just granitetowersequitygroup.com. Contact us, fill out your information. We'll hop on a call.
For sure. And to our listeners, thank you for being part of this conversation. If you got value from today's episode, be sure to subscribe, leave a review, and share with a fellow investor who needs to hear this. Until next time, thank you so much, Dan.
Thank you, Or.